third quarter was a soft quarter and tends to be seasonally soft. Although if you look at the indicators into the fourth quarter, they're actually improved across a number of metrics. So if you look at the weekly data from the Fed, loans last week touched an all-time high, up 5 of the last 7 weeks. C&I showing the fastest growth rate we've seen since early 2017. LIBOR on average is up 18 basis points this quarter, which should drive NIMs up in the quarter. Volatility is up across all asset classes, led by equities, but also up in FICC asset classes, which should aid trading revenues this quarter. So there's certainly some good signs you're seeing so far in the fourth quarter that weren't necessarily prevalent in the third quarter.
So that's going to be the missing ingredient, because some might have argued that, going through 2018, you had probably what should have been, at least on paper, the best operating environment for the banks that we've seen in many years when it comes to the economy, when it comes to corporate demand for credit and just activity in general, consumer confidence. And that really didn't show up in the earnings.
Well, the earnings are actually pretty good, right? So you're going to post record earnings this year. You're seeing record capital returns, so record share buybacks, dividend yields, in the 3% plus area. I think loan growth lagged a bit, and the yield curve flattened, and I think that kind of disappointed investors somewhat. But to the point earlier, right, it looks like loan growth is improving a little bit in here. To the extent you can get any clarity on the tariff and trade situation, we think that's something that's dampening loan growth. So that restraint comes off, that should be beneficial. And then the group overall, they're certainly benefiting just from, positive operating leverage, so revenues growing faster than expenses as you leverage technology, and a very benign credit quality environment, which we think could persist in the near term.
What is wrong with Goldman Sachs, Jason?
Yeah, so, Goldman Sachs, certainly created a lot of headlines in the last couple of weeks as their exposure to this Malaysian fundraising has kind of come to light. You had 2 partners charged, 1 pled guilty, and it kind of creates an overhang. I think the company has basically come out and said there's a chance, they have to face a significant fine. And I think until the market gets clarity in terms of the, how big that could be and the other fallout associated with their, association with 1MDB, it creates an overhang.
Are you worried about Maxine Waters?
If you look, clearly, there's Treasury last year laid out about 200 recommendations they thought would help kind of the regulatory environment for banks. Of those, we think 80% of them do not require congressional approval. It's just kind of the regulators kind of fixing what they've done. And you're actually seeing that in process. You've seen new proposed rules or requests for comments, things on the Volcker rule and stress testing and liquidity ratios. They've already raised this SIFI threshold, so less banks have the most stringent requirements. And so you're already seeing it. So, to the extent that you don't need congressional approval to kind of get the regulatory environment, I think, in a better shape, it's not a source of concern. But, certainly it does create headline noise, as you saw earlier in the week. And it's certainly something to be mindful of.